A Tomahawk cruise missile travels 1,000 miles at 550 mph and finds its target with sub-meter precision. When it detonates, 500 ounces of silver vanish permanently, vaporized into fine particles on impact. No recycling, no recovery. Gone. Operation Epic Fury, February 28, 2026. The largest United States military operation in the Middle East since the 2003 invasion of Iraq. In the first 48 hours, United States Navy destroyers fired an estimated 200 Tomahawks from positions in the Mediterranean and the Arabian Sea. That is 100,000 ounces of silver consumed before the second sunrise. Add the Patriot interceptors fired against Iranian drone salvos. Add the SM-6 rounds from Arleigh Burke-class destroyers. Add the Hellfire missiles on MQ-9 Reapers flying continuous operations over the region. Silver is embedded throughout the entire precision weapon stack. Every detonation is a permanent withdrawal from global above-ground supply. Nobody is running this math. The news is covering the diplomacy, the casualties, the geopolitics. Almost none of it is asking what is physically inside those weapons and what the permanent consumption of that metal means for a market already registering stress indicators that have never been recorded in its modern history. Wednesday, March 4th, 2026. Silver at $84.80, gold at $5,169.90. 6 facts. Nobody in financial media is assembling them into a single picture. The U.S. military is burning silver in active combat while holding exactly 0 ounces in strategic reserve. COMEX registered inventory has collapsed 33% in 5 months and is draining at 650,000 ounces per trading day. May open interest, 401.4 million ounces of paper claims against 87.9 million ounces of deliverable metal. First notice day, April 30th. One picture. Let's build it. Why silver? Not sentiment. Physics. Silver carries the highest electrical conductivity and highest thermal conductivity of any element on the periodic table. In a phone charger, copper works adequately. Inside a guidance chip operating under extreme temperature swings at altitude, inside avionics under electromagnetic stress at 50,000 feet, marginal performance is catastrophic failure. The USGS confirms there is no functional substitute in high-stakes defense applications. The physics is not negotiable. One Tomahawk, approximately 500 ounces of silver embedded in guidance electronics, wiring harnesses, and power cells. At $84.80 spot, that is $42,400 in raw silver against a $1.4 million missile cost. When it detonates, that silver is permanently destroyed. The consumption does not stop at the Tomahawk. Silver-zinc battery chemistry powers torpedoes, submarines, and spacecraft because it delivers exceptional energy density in a compact, reliable package. Silver-plated bearings inside jet turbines prevent catastrophic engine seizure if oil pressure fails at altitude. Every military satellite in orbit, GPS constellations, communications platforms, surveillance assets, runs on silver-coated solar panels and silver-plated RF connectors. The F-35 uses silver throughout its avionics suite to ensure signal integrity under electromagnetic stress. Silver is not peripheral in modern weapon systems. It is load-bearing infrastructure across the entire stack. Under normal peacetime conditions, defense analysts estimate the U.S. industrial base consumes 20 to 30 million ounces annually in direct defense applications. Active high-tempo combat operations push that figure significantly higher. The first 48 hours of Operation Epic Fury consumed 100,000 ounces permanently. Each subsequent 48-hour operational cycle at the same tempo adds another 100,000 ounces to the permanent loss column. Every detonation, irreversible withdrawal. Here is the institutional confession that changes everything that follows. The United States once held the largest government silver reserve in recorded history, over 3 billion ounces during the 1940s and 1950s. That reserve was not a financial asset. It was an industrial backstop, built by planners who had witnessed a specific truth. Mass industrial warfare consumes strategic materials at rates that open commercial markets cannot reliably resupply under wartime conditions. They did not assume the market would solve the problem. They built inventory before the crisis. The Defense Logistics Agency confirmed the national defense stockpile of silver reached effectively zero by early 2002. The facility was closed. The last bars were sold. Every ounce the military needs today must be sourced on the open commercial market in direct competition with solar panel manufacturers consuming 230 million ounces annually in photovoltaics, electric vehicle producers, and semiconductor fabs, all running urgent procurement programs against the same tightening supply. A conservative 3-year operational buffer for the defense industrial base would require 60 to 100 million ounces. That figure is approximately equivalent to the entire current COMEX registered inventory. The only silver legally deliverable against futures contracts, which is already draining at 650,000 ounces per trading day. The reserve was built before the crisis it was designed to absorb. That reserve is gone. The crisis, military demand, a 6-year structural deficit, constrained foreign supply, arrived anyway. Washington is not blind to this. The policy response has already started, and it has a hard limit. In November 2025, the USGS formally designated silver as a critical mineral for the first time in years. That designation is not symbolic. It activates federal funding mechanisms, enables Defense Production Act prioritization, and authorizes government intervention in supply chains on national security grounds. In January 2026, President Trump signed Executive Order 154, directing the Secretary of Defense to review national defense stockpile sufficiency against critical mineral supply shortfalls. The Pentagon has been allocated $7.5 billion to fortify domestic supply chains for strategic materials. The Defense Logistics Agency is already awarding stockpile contracts for antimony, tantalum, and niobium. Silver is on the same draft list. EO 14154 is Washington formally acknowledging in a signed legal document that critical minerals, including silver, cannot be reliably sourced through commercial markets under wartime pressure, and that zero strategic reserve constitutes a documented national security vulnerability. But here is where the policy framework hits a structural wall. The Defense Production Act gives the President authority to redirect any American supplier, a refinery in Nevada, a smelter in Utah, to fulfill military orders ahead of all commercial contracts, by mandate, by law. That authority was invoked during COVID-19 for ventilators. The Defense Production Act stops at the U.S. border. The President cannot direct a mine in Mexico to ship metal to American defense contractors. He cannot override an offtake agreement between a Peruvian operation and a Chinese state-owned enterprise. The United States mines approximately 20% of what it consumes, roughly 1,000 metric tons annually against 5,000 metric tons of total demand. The remaining 80% is imported. The policy response is real. A solution is not operational before April 30th. The COMEX publishes its inventory numbers daily. Here is what those numbers show. On February 9th, 2026, COMEX registered silver inventory, the only metal legally deliverable against futures contracts, stood at approximately 102.26 million ounces. By March 3rd, that figure had fallen to 87.99 million ounces. 14.27 million ounces drained in 22 trading days. 650,000 ounces leaving the exchange every single trading day. Total vault inventory, registered plus eligible combined, stood at 355 million ounces on March 3rd. In October 2025, that same figure was 532 million ounces, a 33% collapse in 5 months. This metal is physically leaving the vaults. March 2026 has already become the most intensive delivery month in modern COMEX history. On February 27th, First Notice Day, 10,526 contracts stood for delivery, representing 52.6 million ounces demanded in a single delivery cycle. The delivery pace is running at multiples of any previously recorded level. Now the May arithmetic. As of March 3rd, May 2026, open interest stood at 80,274 contracts, 401.4 million ounces of paper claims against 87.9 million ounces of registered metal. May 1st Notice Day, April 30th, 2026. The math is not ambiguous. 10% of May OI stands for delivery, 40.1 million ounces, 46% of total registered inventory consumed in one cycle, 15% stands, 60.2 million ounces, 68% of registered inventory, 20% stands, 80.3 million ounces, 91% of registered inventory eliminated with contracts still open. 25% stands, demand exceeds every registered ounce in the entire COMEX system. Every bar, contracts still unfulfilled. In January 2026, approximately 62% of open interest entering the delivery window demanded physical metal, not 25%, 62. That delivery intensity drove silver to its all-time high of 121.67 on January 29th. Since that high was set, the physical conditions have not improved. They have tightened. 3 instruments are measuring that tightness in real time. The 1-year silver swap rate as of March 3rd, negative 2.973%. With the risk-free rate near 4.25% and storage costs near 0.27%, a balanced 1-year silver forward should trade approximately 4.5% above spot. Negative 2.973% means the market is pricing physical delivery 1-year forward at 7.2% below theoretical fair value. Market participants accepting a forward discount to guarantee physical delivery rather than risk being unable to source metal at any price 12 months from now. That is the most direct available financial measurement of structural scarcity. The 1-month lease rate 1.72 to 3%, more than 30 times the 5-year historical average. The entire forward curve is inverted. Backwardation across the strip. May futures at $83.47, July futures at $84.80. Buyers paying more for immediate metal than deferred because they need it now and cannot guarantee sourcing it later. The COMEX stress index, a composite of registered inventory levels, the OI to deliverable metal ratio, lease rates, swap rates, backwardation depth, and delivery intensity, stood at 79 out of 88 as of early March. The previous all-time record was 64, set in September 2025. The current reading is 23% above any previously recorded level in the index's history. Silver is at 84.80, 29% below its all-time high set 5 weeks ago. While every physical market indicator has worsened since that high was set, one of these markets is pricing the metal correctly. The other will be forced to correct. Who is standing for delivery? Not retail coin stackers. The primary institutional parties taking physical metal in size during March 2026 delivery have been major financial institutions, specifically entities including Bank of America and Citigroup. When institutions of that scale accept commodity delivery, they are not capitalizing on a short-term price swing. They are accumulating the physical asset itself, a decision that reflects a forward view on silver's availability that is fundamentally different from what the paper price implies. The ETF data from February is the most revealing evidence in this entire story. Since early February 2026, retail investors net sold approximately 15 million ounces of silver through ETF redemptions. SLV holdings fell from roughly 842 million ounces to approximately 827 million ounces at the trough. 15 million ounces of selling should have added supply and produced measurable relief to physical tightness. It produced zero. COMEX registered inventory continued falling throughout the entire selling period. The lease rate did not normalize. The swap rate did not return to positive. The backwardation did not flip to contango. Institutional buyers absorbed every ounce retail sold, transferring physical metal from ETF vaults into institutional balance sheets through the COMEX delivery process without relieving any underlying tightness. Retail liquidated at lower prices. Institutions accumulated at those same lower prices. By March 3rd, SLV had reported $1.75 billion of net inflows over the prior 30 days. The retail bid is returning, but SLV was simultaneously trading at a near 5% discount to NAV, a meaningful anomaly in a market that normally trades within fractions of a percent, because authorized participants continuously arbitrage any deviation by depositing physical silver with the trust custodian. Note the contrast. Sprott's PSLV, which holds fully allocated, audited physical silver, was trading near par during the same period. Institutional capital was not fleeing silver. It was moving into the instruments where physical backing is genuinely verified. The 5% SLV discount is not a silver problem. It is a sourcing problem. In a normally functioning commodity market, if one exchange runs short of physical metal, the premium attracts supply from wherever it exists cheapest. Metal flows toward the shortage. Prices converge. The problem self-corrects. That mechanism requires the metal to be movable between markets. China has just made a critical portion of global above-ground silver structurally harder to move by deliberate, coordinated government policy. In January 2026, China implemented a silver export licensing regime requiring all exporters to hold at least 80 metric tons of annual production capacity. That threshold immediately excluded the majority of smaller Chinese producers and traders from the export market. On January 26th, the SHFE cut daily silver position opening limits from 3,000 to 800 lots per session, a 73% reduction in a single regulatory action. Multiple Chinese silver and gold investment funds suspended new subscriptions beginning January 28th. These are not isolated adjustments. They are coordinated interventions by a government that has designated silver as a strategic material and is restricting outflows to build its own domestic inventory. The physical result is documented. Combined SHFE and SGE silver vault stocks in China had fallen to 752 metric tons, approximately 24.2 million ounces, the lowest level recorded in a decade. Against 230 million ounces of annual Chinese industrial silver consumption, solar panels, EV batteries, electronics, 24 million ounces represents approximately 5 weeks of industrial demand. That is not a strategic buffer. That is the absence of one. China implemented export controls specifically to prevent its own scarcity from being relieved by outflows to Western markets. The market is confirming this in real time. Shanghai silver was trading at a 17% premium over Western spot prices in early March. In a liquid market with functioning arbitrage, the same metal does not sustain a 17% cross-market premium. When it persists, the arbitrage mechanism has been structurally blocked. The COMEX's traditional backstop, drawing on Asian vault stocks, relying on global price differentials to attract Eastern metal westward, has been deliberately and formally closed by Beijing. The May delivery clock is running with the Eastern door locked. As of Wednesday, March 4, 2026, 5 structural conditions are operating simultaneously. 1. The U.S. military is consuming silver in active combat and holds 0 ounces in strategic reserve. EO 14154, the critical minerals designation, and the $7.5 billion DPA allocation confirm Washington has acknowledged the vulnerability. They do not confirm a solution is operational before April 30th. 2. Global silver demand has exceeded mine supply for 6 consecutive years. Cumulative deficits since 2021 total approximately 820 million ounces, 1 full year of global mine production drawn down from above-ground inventory over 5 years. The Silver Institute projects a further deficit of 67 million ounces in 2026 alone. New mine development takes 7 to 15 years from discovery to production. These deficits are filled by depleting the inventory COMEX tracks daily. 3. COMEX registered inventory has fallen from 532 million ounces to 87.9 million ounces in 5 months, 33%, while May carries 401.4 million ounces of open interest. At January's 62% delivery rate, the math does not balance. Even at 10%, it barely holds. 4. 15 million ounces of retail ETF selling produced 0 physical market relief. Institutions absorbed every ounce. SLV trades at a 5% NAV discount. The paper physical link is under documented measurable stress. 5. China has locked its silver behind export licensing, cut position limits 73%, and built a 17% Shanghai premium over Western prices. The arbitrage path east to west has been deliberately constrained. The stress index is at 79 out of 88, the highest ever recorded, 23% above the prior all-time record. The paper price is 29% below the all-time high set when physical conditions were already extreme. Since that high, the physical market has only tightened further. One of these two markets is wrong. Depending on where you sit today, here is what this data means. If you hold physical silver, the structural case for holding through the volatility between now and April 30th is built into every number above. Paper price swings on the daily chart reflect macro variables, dollar strength, margin adjustments, institutional positioning. They do not reflect physical market conditions. The 3 signals that matter: lease rate, swap rate, and registered inventory trajectory. When the paper price drops, check those 3 numbers. If none of them normalize, the physical story has not changed. If you hold paper silver, ETF shares, futures positions, February's SLV data is your warning. Retail sold 15 million ounces, institutions absorbed it, physical tightness deepened. The SLV NAV discount persists because the authorized participant arbitrage is breaking under sourcing pressure. Under Defense Production Act authority, domestic silver production can be legally redirected to military priority before it reaches commercial channels. Paper instruments that depend on commercial supply chains carry a legal exposure that physical metal already in private possession does not. If you hold no silver, April 30th is a structural forcing event, a known date with a known mathematical gap between 401.4 million ounces of paper claims and 87.9 million ounces of deliverable metal that every May contract holder must resolve before that date. Not a prediction. A calendar entry with published data behind it. Keith Neumeyer, CEO of First Majestic Silver, has publicly stated that all-in sustaining production costs across major silver operations now exceed $20 per ounce, establishing a hard production cost floor beneath current spot. The paper price is not reflecting the physical reality. Yet. Here is the historical precedent that makes the zero reserve situation legible. The Manhattan Project borrowed 430 million ounces of silver from the United States Treasury, used to build the electromagnetic separation coils required to isolate uranium isotopes for the first atomic weapons. At today's global mine production rates of 830 to 850 million ounces per year, 430 million ounces represents more than half of annual global output. The entire operation depended on that silver existing in a vault before the wartime need arose. The planners who built that reserve had seen the lesson Operation Epic Fury is now field testing in real time. Commercial markets cannot supply mass industrial warfare at the pace warfare demands. The Manhattan Project drew from inventory. The current defense industrial base must bid in an open market in its 6th consecutive year of structural shortage. The reserve was sold. The crisis arrived anyway. That gap, between when a reserve is needed and when it can be rebuilt, is the defining constraint of this entire setup. Gold at $5,169.90, silver at $84.80. Gold-silver ratio, approximately 63.1. On January 29, 2026, when silver hit its all-time high of 121.67, gold was near current levels. The ratio at that high, approximately 45.1. Since then, every measurable physical indicator has worsened. Silver has been repriced 29% lower on paper. Gold has barely moved. The divergence is mechanical, not fundamental. The CME raised margin requirements from 15% to 18% on January 29th, forcing mass liquidation of leveraged long positions in a single session. Silver fell from $121.67 to approximately $80. A second wave, a dollar surge combined with an ISM prices paid print of 70.5, the highest since June 2022, drove silver to $78 before recovery to current levels. Both events were paper market mechanics. Neither resolved the physical shortage. Registered inventory is lower now than before either event. If the ratio returns to 45.1 at today's gold price, silver at 115. At 50.1, silver at 103. At 55.1, silver at 94. And for the structural long-term perspective, silver exists in the Earth's crust at a geological ratio of approximately 15.1 to gold. Current market ratio, 63.1, 4 times the geological mean. At 15.1, against today's gold price, silver trades at $344. Analysts Lynn Alden and Rick Rule have cited that geological mean as the ultimate structural reversion case. Price targets without catalysts are noise. The catalyst has a calendar entry, April 30th. Silver at $84.80, gold at $5,169.90, ratio 63.1, COMEX registered inventory, 87.9 million ounces, draining at 650,000 per day, may open interest 401.4 million ounces. April 30th first notice day, January delivery rate 62%, stress index 79 out of 88, the highest ever recorded. These are published numbers, the timeline is a calendar entry. The paper price is the noise, the physical indicators are the signal, stack accordingly. If this breakdown changed how you understand what is building in this market, hit like and subscribe. It puts this information in front of more people who need to see it. If you think I missed a variable, tell me in the comments. I read them all.